just starting off with a few very easy openers here. So some of you know and have been at events recently that Chris released a book recently, Crypto Dad, which is his well-earned nickname. Some probably know the story, others may not. So I wanted to give Chris the chance to kick us off and tell us a little bit about his journey in writing the book. And it's truly an enjoyable book. I can tell you that as someone who has cracked it open.
Thanks, Kathy. And it's great to be with all of you. It's great to be with my good friend, Brian Brooks. And Brian and I, at various times, served together with Kathy Kraninger on the FSOC, the Financial Stability Oversight Council. So it's great to be back together. And I understand this morning there may have been a disturbance in the force. So Brian and I are going to try to restore some of the force for you today. But I do want to tell you a story about the moniker Crypto Dad, because it's actually a story of how sometimes challenging it is to change the status quo. As I think many of you know, during the first Bitcoin rally in 2017, the CFTC was approached by two of its biggest operators, the CME and the CBOE, about launching Bitcoin futures. And as those applications were going through the commission, it was remarkable how much resistance the commission faced to find a way to either stall or stop those self-certification of Bitcoin futures. And it wasn't just regulators, although there was a healthy dose of regulators in the US and abroad that were calling us saying, do not let this go forward because you're legitimizing Bitcoin if you do. But it was the industry itself. A lot of legacy players in the industry, a lot of the wirehouses and big bank institutions were calling us, telling us not to let this go forward. There was a full-page ad in the Wall Street Journal addressed to me as chairman of the CFTC saying, find a way to stop this from happening. There were journalists in the legacy press that were writing op-eds lampooning our efforts to do this. And you know, it was that notion of, if you do this, you're legitimizing Bitcoin, that kept coming into my mind, because I thought, it's not for me as an unelected bureaucrat to legitimize a legal activity. It's for the market to determine what is the legitimacy of Bitcoin. And the only way the market could do that is if we let this go forward to create the world's first regulated, transparent, deep, and liquid marketplace for a version of crypto, which was Bitcoin futures. And it was that realization that it was for the marketplace, the greatest crowdsourcing instrument humankind has ever created, markets, to determine the legitimacy or illegitimacy of Bitcoin. It wasn't for us. But anyway, not long after we gave the green light to that in December 2017, I received one of these formal summonses from the Senate Banking Committee to appear before the committee and basically explain what we had done. And I knew, depending on what side of the technological divide those senators were sitting, I would either be dragged over the coals or perhaps from a few voices applauded for allowing Bitcoin futures to go forward. So of course, I prepared the sort of mandatory 60-page submission to the committee that was due a few days before, going through chapter and verse of everything we had done and basically justifying why we had allowed Bitcoin futures to go forward. And the night before, when I was preparing to give my opening remarks, and if you've ever watched these Senate testimonies, you know the opening remarks are 5 minutes in length, and you've got a light in front of you that goes green, yellow, and red, and at red, if you're not done, you get gavelled to stop. So it's 5 minutes, which works out to about 600 or 700 words, and there's no way I could summarize those 60 pages into 700 words. So I pushed that aside, and I looked up at the dais, and in the Senate Banking Committee, by the way, the senators all sit 6 feet above the witness table, right? So they can look down on you, and you have to crane your neck to look up at them. And I said, Senators, I know I'm here as the chairman of an agency, but if you don't mind, I'd just like to talk to you as a dad. And I said, you know, for years I've tried to interest my own kids and my nieces and nephews in the stock market, and absolutely no interest at all. But crypto has captured their imagination. I've just come back from our family ski trip, and all my kids and all my nieces wanted to talk about is Bitcoin. And you know, Uncle Chris, you started Bitcoin futures. You know, what does this mean? And I said, I think we owe it to this generation to respect their interest in crypto, not with disdain and dismissiveness, but with real, let's get it right. Let's spend the time, let's dig into this, let's get this right. And so it was that, because I said I want to talk to you as a dad, that my handle, just exploded on crypto. I got 50,000 Twitter followers in the next 48 hours, and the meme Crypto Dad, and a few others that I didn't like quite as much, resulted in that. Anyway, that's where Crypto Dad came from, and I still feel that way today. As policymakers, whether it's former policymakers or it's the current crew, and by the way, Brian and I are here to tell you, regulators come and go. To use the Washington parlance, they're transitory. The current environment is transitory. Innovation cannot be stopped. This is a generational thing. This will happen. We've just got to get it right.
Absolutely fantastic story, certainly in terms of the nickname, and well earned. And Brian was an early adopter and no stranger to the crypto industry even before he joined us in government. And he's also had an interesting year in terms of a path that got him to the Bitfury seat that he's in now. So I wanted to give him a chance to tell us what he's been doing for the last 9 months or so.
God, that is such a great question. I would sort of pick up where Chris left off. So I too have kids, and my kids, nobody wants to call me Crypto Dad because they've met my kids, and so that's probably a different thing entirely. But just last night, I'm texting with my 21-year-old son, my second son, who's a senior in college, and he's texting me about this idea he's got for a decentralized social media platform with no moderation, where you need tokens, and staking rights to be able to participate, but nobody can be canceled. And I'm thinking, I must have actually done something right. With this kid in particular, I wouldn't have thought that, but maybe things, turn out in the end. It's kind of amazing. What I would tell you is, I spent a fair amount, if you want to fast forward to how I got to the last 9 months, I spent a fair amount of my time working on sort of the most broken aspects of the financial system. So for me, I think that predicted that I would eventually do something like this long before crypto even existed. So, somebody somewhere out there in the crowd is my friend Kayvon Sadeghi, who used to work with me representing, one of the biggest subprime mortgage companies, both pre and post-crisis, okay? Then I went and helped take over IndyMac Bank after it failed, man. And then I went to go be general counsel of Fannie Mae, like, holy cow. So if you've spent time inside of those kinds of organizations, you really do get that there not only must be a better way, but there better be a better way, right? Decision making, capital allocation, command and control has skewed so many aspects of the financial system. There ought to be a better way. And that's what led me to Coinbase, in 2018, was the notion, and the irony is, one of my friends who was part of the IndyMac takeover crew had gone to Coinbase as the CFO, and so she and I both had that same insight, which is there can be a better way. And one of the things I find most interesting about all of this, and this is the journey that took me to the present day, is initially my view of crypto was the same as most people's view of crypto, which is it's an asset class in search of a use case. That's what people sort of thought about in 2016 and 2017, is like, we're not going to win unless we can show what it's for. I then came to realize, as I spent more time with real internet people who had worked on the original internet and its iterations, that you actually don't need to know what it's for. That is the lesson of the internet, is you're building networks, you're building platforms, and markets will come and show you what it's for later. So, in the 90s, people thought of the internet as a toy. They thought that AOL was the future because walled gardens and curated content that you can view on a screen was what the internet was about. They didn't realize that millions of people building things that can't be predicted, that's markets, as Chris says, is what it's all about. That's kind of what I figured out. And so when I got to the government, I realized I'm not yet at the 9-month mark, Kathy, but I'm getting there. When I got to the government, it was super clear to me that what needed to be fixed was the idea that we can't allow this to happen until somebody can show us a use case. That is the problem I was trying to solve. And so the message that I was trying to convey in a whole series of guidance letters, ultimately bank charters and things like that, was what we know is that the future is networked. Beyond that, we don't actually have to know. That's not the role of government in a market economy. The role of government is to create a set of risk protection guardrails and allow markets to decide what's valuable. To riff off of Chris's sort of comment, it's sort of like lots of stocks on the New York Stock Exchange ultimately go to zero because it turns out people don't like that car, they like these other cars. But we don't ask the SEC to make a judgment about whether Teslas or Buicks are better vehicles. We let the market decide that, right? And it's the same thing ultimately with crypto projects. Some will succeed, many will fail, but it's not our role as government officials to speak to that. Which brings me to, what do you do when you leave the government, right? Well, what you do is if you really believe in this stuff, you try and find projects and drive them forward. Obviously, the first start with me was a little of a false start. That was an interesting 90 days. One day when statutes of limitations have expired, perhaps I will tell that story. But what I'm doing now is actually something I'm super excited about. So I'm now running a company called Bitfury, which is one of like the original gangster Bitcoin miners from 2011. These guys were the most important mining company, the most important Bitcoin validator for a long time. And what's happened over the last couple of years that got me really excited about it is they've taken the concept of being a Bitcoin, validator and expanded it to the idea of if you're in that business, what you really should be is you should be the infrastructure layer of crypto. So there are people who are building applications and consumer-facing things. That's one line of business. But all of that stuff has to run on machines that have specific technical specifications. They have to have certain software layers that make it safe and legal and transparent for the world, all of which affects the ability of Bitcoin and other cryptocurrencies to survive and thrive. So you might think about it as, in the 90s, if you were an internet investor, you could invest in an early iteration of Amazon, or you can invest in Cisco systems. We're kind of like the Cisco systems of the Internet 3.
It's fascinating, as always, to hear Brian talk about his journey, so I appreciate that. And I can identify, certainly, with the notion of what do you do when you leave the government? I spent a little more than 20 years working in various agencies in the U.S. government, and frankly, in a lot of startups, too. I was at the Department of Transportation on September 11th, 2001. And when the terrorist attack happened, obviously, we were not thinking too much about security in that agency, not surprising. Everything we did changed. We were actually talking about the safety of Mexican trucks crossing into the U.S. From Mexico and what standards they should meet. It was actually a big political issue that summer. And obviously, everything changed. So the stand-up of TSA, the stand-up of the Department of Homeland Security, I had the honor, obviously, of running the Consumer Financial Protection Bureau, again, at a very early stage in its evolution. So leaving all of that, frankly, the most exciting thing that I was involved in at the CFPB was the financial innovation conversation. As we think about inclusion and access and how many people have been left behind in developed economies, how do we actually reach those people? What do we do? And so those conversations, meeting with innovators, having an open door to those innovators and a conversation about exactly the right way to approach them, that's something that I really enjoyed and loved. So as I looked at coming out, and I talked to these fine two gentlemen as well, so they certainly had an influence on where I ended up, I found Solidus Labs. Started talking to Chen in May. I think probably half the room is here in part because of conversations they've had with Chen, perhaps over drinks too. But just a fantastic group of people and a very cool mission. DACOM being a reason why it was so appealing to come. Having a forum to talk about compliance and regulation and what it means in this new industry. Actually bringing people together to talk about that. Performing risk monitoring services as an industry and coming forward with what does that look like? How should that look? Frankly, from my vantage point, the most valuable conversations in the government were with industry coming forward to say, we're concerned about the things that you're concerned about. We're concerned about fraud and manipulation. This is what we're doing about it. This is the structure that you should put in place. These are the benefits of blockchain technology in actually doing that differently than you do that with respect to traditional finance. And I know many of us are concerned about hearing things that are applying what is done in traditional finance to blockchain technology and to crypto in a way that just does not make sense and doesn't apply. So I do think we have a huge opportunity as industry, and I'm excited, as I said, at Solidus Labs to be part of that. But that's what we'll get into a little bit now here is the regulatory framework. We heard, and Brian, I'll kick to you first, but both of you have a lot to say on this topic. But just that notion about glomming onto the asset class question, is that the way to be thinking about digital assets or crypto, or what should the regulatory structure look like? What can industry do to help help frame that out and think about that.
Yeah, so Kathy, that is a great question. I think one of the big problems we have in breaking through in Washington and frankly in the state governments as well is this idea that crypto is a unitary thing. And thus, you hear people talk about should there be a special crypto regulator that's different from the bank regulators or the broker-dealer regulators or whatever. I come back to what I said earlier, which is the ultimate project that we're building, right, is a new set of networks where, unlike the old network, which is kind of owned by Google and Facebook and 4 or 5 other companies, this is a network that is owned by its users. That's what we're ultimately building. But what's going on those networks kind of remains to be seen. I mean, we're kind of in the 3rd or 4th inning, seeing some of the interesting projects that are starting to get traction. But crypto itself is not a unitary thing. And so let me unpack that for a second and talk about the way that I think it fits into the current regulatory structure that we have. I'll preface by saying the US has one of the weirdest, most fragmented, and most suboptimal systems in the world. And Chris and I, have written about this and talked about this in many other forums. The way the US regulatory system is different from most countries is we have like 39 different financial regulators. If you count the states, maybe like 115 financial regulators. It's really kind of bananas. You have 3 different agencies that regulate banks. You have 1 agency that regulates equity markets, another that regulates derivatives and commodities markets. You have yet another one that regulates monetary policy and the money supply and the payment system. It's really odd. And so you have a little bit of vying for primacy and trying to shoehorn crypto into a single place. I think that's the wrong way to think about it because our current system is set up based on something that we think about as entity regulation. I regulated the banks, Chris regulated the commodities and derivatives markets, et cetera. And so we have jurisdiction into one kind of company. The way to think about crypto, I believe, is fundamentally it's about building networks. And we actually don't regulate networks in this country. There is no internet regulator. And that was a conscious decision that some of you in the audience actually worked on in the 90s, is to make sure that there isn't an internet regulator. Instead, the way the internet is regulated is based on the underlying activity that's being built on that. And so, for example, if you're an advertiser on the internet, there are FTC rules about truth in advertising. If you're a bank that has an internet app, there are banking regulations about how you have to interact and what kind of security you observe, et cetera, et cetera. But we don't regulate the networks. And so what I think about here is some of what goes on Web3 is financial in nature and involves things like lending and credit transactions. And we have a set of rules about lending and credit transactions. The new Web3 approach solves some of those issues, and so we don't necessarily need to impose bank-like regulation on a decentralized lender. I mean, for example, if you have an algorithmic lender, it's not 100% clear that certain concept of disclosure or certain risk management protocols apply when humans aren't involved, but some may, right? You have decentralized exchanges, which are engaged in certain kinds of activity that are probably well covered by existing rules. But the point is to focus on the activity and the risk and ask yourself what's going on here. The main point I want to land with you, because I don't want to filibuster this answer, but the main point I want to land, it kind of picks up on a comment that was made during the SEC discussion earlier today, which is that similar activities should be regulated similarly. I would propose that we modify that slightly. I think that similar risks should be regulated similarly, but I think the idea of similar activities being regulated similarly is a little bit goofy in a way that bears some scrutiny. The way I think about it is, okay, it is my favorite example, is long, long ago when television was invented, we established the Federal Communications Commission and gave it the power to issue broadcast licenses to television stations and said you may not broadcast television over the airwaves without a license. And we did that for obvious reasons. There's limited spectrum, we can't have stations interfering with each other, et cetera, so that all makes sense. Race forward 50 years and somebody invents YouTube. YouTube similarly is distributing video content that we can watch on a screen. It's very, very similar to television. If you think it's a similar activity that requires a broadcast TV license, we wouldn't have YouTube because YouTube wouldn't be solving any problems, right? If you required them to have the same regulatory overhang that NBC has, it wouldn't exist. But everybody understood when YouTube was invented that it didn't need to comply with broadcast licensing rules because it wasn't broadcasting. It didn't create the risk that those licensing rules were designed to solve. So too here, okay? One of the main reasons that we have a lot of the disclosure rules, the banking laws, and other kinds of things is because there are risks created when human beings are involved in making decisions. They might be negligent, they might be self-dealing, they might be discriminators, or they might be, greedy or something like that, and we constrain that through laws. When you start doing those functions algorithmically and you take all of that out of the equation, I would just ask, why is it so clear that the legacy laws apply to the algorithmic function just because it's the same activity, when the whole point of the innovation was to solve the risk that the original law was a Band-Aid for? That's an insight we do not do a great job as an industry of telling, and I think that is at the core of the misunderstanding between us and some of the legacy regulatory ideas you heard earlier.
Well, absolutely the case, and Chris has a lot to talk about with respect to that. I just add two facets again from that conversation this morning. It's, the notion that the regulation needs to be in place for the industry to flourish, and the second thing is the notion that there need to be gatekeepers, or that there are gatekeepers, and frankly that we're in this room as gatekeepers. What is that dynamic too at play here with respect to how regulation should proceed? So again, framework.
Kathy, you began the question a few minutes ago by talking about the potential of this new innovation to bring more people into financial inclusion, to lower costs, to reduce latency, and to take out some of the rent-seeking behavior that exists in our financial system. And, our financial system was state-of-the-art in the 20th century, but its shortcomings are rapidly becoming apparent. And so outside the Beltway, the question is being asked, how do we use this technology to bring more people in? How do we lower costs? How do we shorten time frames? How do we go to a 24/7, 365-day-a-year financial system? Yet inside the Beltway, the question is all about, is it your jurisdiction? Is it my jurisdiction? Is it under ours? Is it a security? Is it a commodity? It's almost as if the Beltway is still in the 20th century and the rest of the world has moved into the 21st century. The claim that this innovation, cryptocurrency, won't last long if it's not regulated is such a wooden plug of a question. But regulated how? It's not just regulated or unregulated, as if regulation all by itself is the answer to every question. It's what kind of regulation? In my book, I talk about, the claim was made there was insufficient regulation of the financial market that caused the financial crisis. It's never about quantity of regulation. It's always about quality. Is the regulation fit for purpose? Does it address the issues? And so I think we need to stop, debating commodity, and I say this as a former CFTC chairman. Commodity, that definition, commodity means a lot to me, but I think we need to move beyond that old wooden conversation and start saying, how do we harness this technology to bring more people into financial access? How do we harness this technology to take some of the rent-seeking behavior out of the antiquatedness of our financial system? How do we use this to move forward and modernize? Those were the questions we asked about the early internet. For some reason, we're just stuck in some sort of time warp in our policy response. The Washington policy response to the first internet was first do no harm. And it was a brilliant policy response. It worked well. It made the United States the leader in the first wave of the internet. Our policy response seems to be right now, first protect the legacy infrastructure. First protect the legacy regulatory framework. It's not how do we advance this technology, it's how do we seem to protect what's happening, what the Beltway structure looks like. And it's such a disappointment as quite frankly, as an American who benefited so much from that first wave of the internet, we're not looking at this, how do we benefit from it? We're just seeming to say, how do we preserve the status quo?
Now that definitely is the fundamental challenge. I know there's also discussion of bringing in a new regulator. I think you probably would note that this panel is definitely not on board with that as a concept. I think Brian outlined it well with the number of regulators involved, and it is what it is. And I think there's a huge opportunity to work together, as regulators in terms of taking advantage of what the expertise and approach is of each of the regulators and encouraging that conversation and looking at those opportunities to really come together. It was asked this morning, certainly of Chair Gensler, about the SEC CFTC conversation too. I think some interesting history perhaps on the birth of the CFTC, Chris, and also your perspective on the two agencies, their roles, responsibilities, opportunities here for thinking about what should happen in this space in particular.
Well, when everybody's done reading CryptoDad, I have another book recommendation for you. And that's Leo Malamud's new book. Leo Malamud, the creator of Financial Future, is one of the great OGs of the Chicago futures and derivatives industry, who, along with Dr. Richard Sandor and other luminaries, invented financial futures in the 1970s. And financial futures was actually a step change in the ability to control financial risk. Until then, you could control agricultural risk using ag futures. But the creation of financial futures was so fundamental. The United States could have never, the world could have never gone off the gold standard if there wasn't a way of controlling or mitigating the risk of moving in global interest rates and currency. And so the creation of financial futures, cash-settled financial futures, and Leo Malamud talks about this in the book. But here's the point. They were so worried that if the SEC regulated it, they would destroy the product itself, that they went to the Ford administration and said, you know, there's a bureau at the Department of Agriculture that regulates the futures markets. Let's create it into an independent agency, and let's get a mandate to further market innovation, hence the CFTC. So as we look around today, at prior times, we have actually advanced new product, new innovation development by saying, what is the right regulatory framework that furthers innovation? And my worry right now is we're in this Washington, is it CFTC, is it SEC? The current focus seems to be on one factor only, and that is investor protection, which is the SEC's mandate. But there are other important mandates, like the CFTC's mandate to further innovation along with markets free of fraud and manipulation and market durability and market health. What we need to do is go back to first principles. We need to look at this innovation, I think as Brian has done, and stop focusing so much on entities and focus on activities and say, what is our national policy for this innovation? I do think investor protection has a role to play, but not an exclusive role. That's only one part of this. We also need orderly markets free of fraud and manipulation. We also need to further innovation. So I think what we really do need Congress to step in and declare, after good, long debate, what is the combination of national policies? What is the right policy response? And they need to instruct the regulators of how to do that. Right now, we've got the regulators almost, in a sense, telling Congress and telling everybody else, we got this covered, it's all about investor protection. I think the national interest is much broader, although it includes investor protection. It's broader than that, and I think we need to establish that as national policy, as Congress and the White House did in the 1990s in a very bipartisan way. I think we need to come together once again, establish first principles. What are our first principles for this innovation? I suggest it's about greater financial inclusion, which, by the way, the current regulatory structure doesn't further with our accredited investor approach, is keeping out the very people that are very attracted to this new innovation. So I think we need to think about inclusion, we need to think about lowering costs, we need to think about modernizing our financial system, we need to think about investor protection, we need to think about a broad range of policy objectives and then set out a framework of how to achieve them.
So maybe I can just comment on that, and because I think that is brilliantly put. I want to come at the question from a different perspective. So Chris has given a great framework of how the government should think differently about this. I totally endorse it. Let me talk a little bit about how companies might think about it as
You're going where I was going to go
right?
anyway. I wanted to make sure we ended on the point of what everyone in this room should do.
Totally. So you know, I have both sat in the regulator's chair and had people come to me and apply for bank charters and propose activities and everything. I've also been the supplicant walking into the SEC and saying, here's my project, what do you think? Ask me after how those calls went. But here's the thing that I've learned from all of that, which is the typical approach that a crypto project takes in going to meet with a government official is basically the following, which is, hey Chris, I would like to launch this new product. Please don't kill it. I think that we don't violate the Commodity Exchange Act. Exactly. Except it's never no. It's actually we can't advise you. You'll get a subpoena later, you know. But it's always, please let me launch my token. Here's how I think I don't violate your statute. Can you give me any kind of assurance? That's generally what's going on. The conversation that should go on begins with, let me tell you what problem we're trying to solve. Okay, so imagine you're going to the SEC, and it is, well, the problem that we're trying to solve, okay, the problem that your laws are trying to solve is a problem of disclosure. And what disclosure is mostly about is, tell me who the management team of this company is, tell me what their experience is, what their strategy is, what their regulatory risks are, et cetera, et cetera. Okay? So the problem we're trying to solve, Mr. SEC Chair, whatever the right word is, okay, Chair. The problem we're trying to solve is there aren't any human beings here. So the graft, the conflict of interest, the self-dealing that most securities disclosures are all about, we don't have that. We have algorithmic capital allocation. So we want to show you the code and work with your team and get you comfortable with the fact that we've removed that from the system. So we're not saying that we want to evade your rule. We're saying that your rule was intended as a Band-Aid for a technological past where humans were the critical factor. They're not the critical factor anymore. We've solved the problem, so we're going to reduce the risk in the system. Or, hey, Mr. OCC Controller, the issue that you're trying to solve is creditworthiness and risk, right? And you want to make sure that you don't have concentration risk, or that you're not making loans to people who won't repay, or that you're not engaged in credit discrimination or whatever. And I've solved that better than a bank can, right? I have no concentration risk because there is no money center. There's no risk of contagion because this is purely an algorithmic global liquidity pool, or whatever. Talking about the problem that you're trying to solve, saying, I'm YouTube and they're NBC, they're consuming broadcast airwaves, I'm not consuming broadcast airwaves, you should love me. Because laws are a Band-Aid for human fallibility, and what crypto's all about is taking human fallibility out of the equation, okay, and letting people interact without any of that friction, without the elite central decision makers. All we're about is decentralization, and almost all regulation is about is constraining craven, greedy, or negligent central decision makers. Decentralization is what it's all about. You got to start with that, not end with that, okay? That's my message.
Well, it's certainly good advice in terms of how to approach regulators and the regulator conversation that we have talked about. I know that's important. I'm going to give Chris the chance to at least have the final word here as we wrap up.
So you know, the reason why decentralization is so challenging for regulators is because if you think about the way regulators approach their job to regulate any ecosystem, it can be a financial market ecosystem, medical, taxi and medallions, anything. Regulators look at the ecosystem and say, okay, where are the intermediaries? Where are the choke points? Where are the bottlenecks? Where are the consolidators? We'll license them. We'll regulate them. We'll give them jobs to do, like gathering information and filing reports with us. In return, we'll give them actually some barriers to entry, some mini monopolies. We'll give them advantages in return. And so regulators have this sort of comfortable environment where they have those intermediaries doing part of their job for them, and it all works. Well, suddenly this new technology comes along and disintermediates the intermediaries. And for regulators, that's a nightmare. It takes them out of their comfort zone. How do we continue to do our job in an entity-based regulatory model when the entities are disintermediated? Well, that goes to Brian's point, because regulators need to think in new terms. Instead of focusing so much on the entities, let's focus on the activities. What are the activities that the actual mandate you got from the Congress were designed to do? To protect, to prevent illicit activity, to prevent fraud manipulation, market manipulation. Do that on an activity-based approach. Now they say, well, wait a minute, how do we do that? Well, guess what? This very new blockchain technology that's disintermediating everything is giving you, the regulators, the tools you need to do activities-based regulation. How do you do that? Because you become a node on the blockchain. You see all the transaction flow, and you use big data analysis, artificial intelligence, and other tools to recognize patterns of behavior and then go after the misbehavior. Now, that may sound so foreign in financial markets, but it's what we do every day on the interstate highway system. You don't stop at a toll booth before you get on the highway and say, here's who I am, here's where I live, here's my social security number, you have all the information you need so I can go on the highway, and if I do anything wrong, you can get me. That's not what we do. You go on the highway, and the state police use pattern recognition, speeding, weaving in and out of traffic, to detect that you may be engaged in illicit conduct. They pull you over, and what do? They then get your identity. So pattern recognition, activity-based regulation is something we actually know. It's just not what we're used to using in a lot of regulated markets. We can go there. Regulators just need to see with new eyes as to what's happening.
Nope, and that conversation on behavior versus identity, one or the other, which first or second, we'll have to hold for another day. But I want to thank you very much for joining us today, and please welcome me in thanking them for their time.